I'm at Citi in the social finance team, and in my spare time, I'm a director of the Financial Inclusion Forum, and I'm really excited that you're joining us for this conversation. And I think this you'll find interesting. In the impact investment space, I think private debt is great. If you're not in the private debt space, you're probably not really involved in the heart of impact investment in emerging markets. And I think what today really brings together is a number of different perspectives. There are perspectives of financiers, of different types of financiers. There is a perspective from a company that is doing really interesting and challenging work and has experience as a borrower. And at the same time, Alan Overy has very kindly lent their expertise on innovation and really what's the frontier in impact investing in emerging markets. So without further ado, we'll dive in. We'll have a panel conversation, and then we'll open it up to questions after that. So what I'm going to first ask my wonderful panelists to do is to introduce themselves, but also talk a little bit about what they've seen work in their space. And we'll go from there. So maybe, Daisy, I'll let you go first.
Good evening, everybody. My name is Adeze Uso, and I head the corporate finance team at Balangona. So what is Balangona? The name means great farm in Hausa language, which is a language spoken in northern Nigeria. And essentially what we do as a business is we're an agri-tech agricultural franchise model that supports smallholder farmers by lifting them out of poverty. So our focus has really been on improving and increasing their profitability and productivity. And we've successfully been able to do that and increase productivity and profitability by 2 times the national average since inception. So the business has been running for about 10 years. And in that time, we've supported about 180,000 smallholder farmers by giving them about 360,000 loans. Now we provide a holistic range of services. So this is around education and training, agricultural inputs, financial credits, as well as harvest services to ensure that we're lifting these individuals out of poverty and hitting those SDG goals, job creation, poverty alleviation, as well as improving education, nutrition in the communities in which we operate. Now for us, really the journey when it comes to private debt has been one that started many years ago. So we started as an organization that was relying more heavily on debt coming from concessionary funders. So we borrowed a lot from foundations, from DFIs, and then as the model became more proven and tested, we were able to start tapping into that private debt market. So a lot of the learnings that I will share today is really around the structures that we've put in place as an organization to make sure that the wheels are turning so that it's more efficient and more effective for both the borrower and for the lender to tap into that catalytic capital that's required to really scale the impact that we're making. So our goal as an organization is to hit 1 million farmers by 2025. So this is our journey towards that.
Hi everyone. So I'm James Dorey with Lionshead Global Partners. Lionshead is an investment firm set up around 2008, really by people with backgrounds in the global capital markets. These days we do 2 main things. So we run a series of Africa-focused credit funds, and I'll talk a little bit about their distinguishing features and where they sit within the sort of spectrum of private debt space. And then we have an investment banking business that has large overlap with, I guess, the development finance community, particularly in the part of that business that I now run, which is largely focused around energy transition. A large part of the finance providers for counterparties we work with in the debt space and the private equity space are development finance institutions, multilateral development banks, and increasingly and interestingly with institutional investors participating alongside those DFIs, maybe with insurance products, etc. We're seeing a sort of a convergence in some ways between what's going on in development finance and capital markets. Regarding our funds, so there is, I think the first of the post-pandemic panels I sat on was around private debt, and I was hosting it actually, and so I tried to sort of set the scene about what do we predominantly talk about in the private debt space. It seems to me to be usually higher yielding debt for growth, so inventory finance, equipment finance, holdco finance, but it's really people coming from a private equity lens turning their hands at credit and debt often as a yield model. Our approach has always been slightly different, and actually I thought Bill Orchard referenced in the room that those sorts of companies sometimes see as our peers. Our debt funds tend to be quite prescribed and quite focused on trying to solve a problem. So the first fund, and the fund that I was running until last year, was called African Local Currency Bond Fund, and it was focused around helping companies raise debt in their own markets for the first time. We talk about bonds; these weren't really highly traded, highly liquid bonds. It was really about how do you tap funding from pension funds, insurance companies, high net worths in the domestic market and the domestic regulatory setting. Second fund is focused on structured credit solutions for energy access, solar home systems and similar. So that's bringing, let's say, securitization and structured finance mindset to providing debt to a space that's largely unprofitable at this point. Then our third fund, and now our biggest fund, is called the Facility for Energy Inclusion. It's really been a pioneer in providing debt to commercial and industrial renewable energy, but more broadly speaking, funds smaller energy projects. And our most recent fund on the debt side is called Africa Go Green, and that is still sort of painting its picture and developing its strategy, but is really focused on decarbonising industry in Africa. And so that's a fairly broad mandate, fairly broad remit, but one that takes it from e-mobility, energy efficiency in the built environment, alternative fuels, alternative forms of heat and cooling. So has a potential to be quite exciting and with the ability to expand. So I'll leave it there on the intro. I guess there's several themes I can shoot off from.
Well, thank you. My name's Alex Morezo. I'm in Allen & Overy's International Capital Markets team. My focus is on structured finance and securitization deals. We do a full spectrum of those types of deals. And as a lot of you will know, since the credit crunch, the private debt space, private transactions really boomed. Been over 10 years now. And over the last few years, we've seen the queries of impact investment. And I've been involved in a couple of transactions now in that space, particularly around, as James mentioned, solar home systems in one of the African nations. And so that successfully closed a couple of years ago, and we're working on a repeat deal now. And we've seen a bit more in that space. We've seen queries around carbon credits. I've seen deals around biodigesters worldwide, really, not just in Africa, but India, South America, really generating a lot of interest in that space. And we help with the structuring of the deals, the due diligence, the kind of things to think about if we're trying to do a transaction like that. I'm not going to go into details on it right now, but to the extent that you want me to expand on some of those themes.
Brilliant, thank you. So I think the picture that emerges, or at least for me, is what we really started off with is loans, and private debt to emerging markets was really institutions lending to borrowers. That's still the case. That is graduating, and I think that Daisy talked about the journey from philanthropic to commercial. But I think there's now interesting innovation still in the private debt market, but looking at bonds and more capital market instruments like securitizations. And I think that's a reflection of growth. I mean, the growth of the underlying companies, growth of the economies that are able to sustain more complex structures, and that of course brings in investors who otherwise wouldn't necessarily be able to participate in the loan format. Maybe Daisy, if I could ask you, and James, you're gonna get a similar question. What for you makes a good lender? And James was coming your way is what makes a good investor?
So what we're looking for when it comes to lenders is, I think, first of all, mission alignment. So ensuring that, overall, we can truly call these lenders our partners in our journey. So ensuring that the direction in which the company is moving in is aligned with the mandates that, either the fund managers or the funds are pushing for. So that there is that cohesiveness between the two parties, and then I would say, secondly, looking at from the perspective of a for-profit organization that is very impact focused, you do want to also ensure that there is that balance between chasing return and also chasing impact. So having lenders that are able to be flexible when it comes to how the transaction is structured, looking at pricing, for example, and also looking at flexibilities around working in markets that are maybe developing markets or emerging markets, where the financial systems are not as, they don't have that depth. So for example, in Nigeria, you have a very strict financial market where collateral is required for every loan that is taken from a Nigerian bank or a Nigerian lender. And this is not just talking about 100% collateral, we're talking about 150%, 200% collateral. So it does really affect small businesses, medium-sized, even large businesses. So what we've structured with some of our lenders right now is, a back-to-back structure that we call it, where the foreign lender is unsecured, and we can use that financing as collateral that is deposited for the local lender, and it unlocks cash for the borrower. So really looking at those flexibilities is what would be really important with lenders.
And I'm sure FX is going to be inevitable in this conversation. You're beginning to touch on it, particularly in an environment like Nigeria, where you need the local currency is probably as important as considerations. James?
Yeah, so investors in our funds, I think the answer is you kind of need both ends of the spectrum in a way. I mean, because we set off with some of our fund sponsors, i.e. in our case, our first fund was anchored by KfW and incubated actually by KfW. A lot of the early IP, if you like, was theirs. What we then did is took that, scaled it up, and formalized a lot of the structures and strategy around what it ought to be doing to maximize their KfW's objectives. But I think in a lot of the time in the impact world, people have there's terms that sound like a win-win, like blending, right? Everyone wants to be senior in the blending environment. No one wants to be junior getting the lower yield. But actually, people like KfW in accessing BMZ funding, so that's the German Ministry of Economic Cooperation and Development, they are a trusted partner. They can go and seed these initiatives. So what does that mean? They can bring some internal expertise themselves. They are patient. They have experience in creating some of these fund structures, at least starting them. And that's a good partner for a firm like us, where we have expertise and coverage across African capital markets. We operate in a number of different sectors. So the theme of that first fund was really around capital markets development. You need to understand financial inclusion of banking. You need to understand energy and infrastructure. You need to understand commodities and agribusiness. But none of that would have been possible without someone saying, right, well, we're going to try and put some capital work to figure out what works, what doesn't work, and find a partner to scale it up. So I can't sort of trumpet ourselves without talking about those sorts of providers. And others out there. There's the UK usually through initiatives like the PIDGE or FSD Africa. The EU Commission has played a role in some of our other funds, particularly in the energy access space. The African Development Bank through an entity called CEFA, Sustainable Energy for Africa. So that's how those highly targeted, highly prescribed funds kind of got started. The question is, what do you do next? How do you scale it up? How do you maximize the impact of those funds? What we've done in the case of the African Local Currency Bond Fund, we have brought in non-developmental LPs through people like Calvert Impact Capital. It's still a mission-driven investor. And so when we're asking ourselves, right, what does the fund need? Access to capital to deploy in these markets, and also optionality around repayment profiles, tenors, currency, as you mentioned. So we started work last year on setting up, or actually taking a further step back. We got the fund rated, first of all, and I think we're on our 4th year of the rating now with Moody's. And the purpose of that was to say, right, this gives us optionality, it gives us some validation over the model, over the structure of the fund and the track record of the fund, and it allows us to go and tap a different type of investor. So the sort of investors we're hoping to tap or to access through what we're calling a medium-term note program, so listed and tradable note program through the German Freiwillige, is a social note program. The first issuance will be planned links to some of our investments in the connectivity space, so telcos and data businesses in West Africa. And under that program, we can tap different types of investors. I mean, to the point about what makes one of those investors good, I think what I'm trying to get at, I guess, is we're sort of trying to mature the funding base of that fund to a point where we're not very picky about who the investor is. We're trying to say, right, well, to scale it, you need to have access to a capital market, and the market that we've identified is still somewhat niche, but is through this social note program. I think maybe with some of our other funds, I mean, there's interest from some Asian conglomerates in one of our renewable energy funds. I don't think with the sort of funds that we run beyond that sort of seed phase or subordinated capital, all of our funds have at least one layer of junior capital to support the structure. I don't think that there's sort of a true strategic investor that sort of helps you raise funds. It's kind of our job in many ways, but I do think that recognizing that there's particularly if you're trying to mainstream an asset class like African local corporate bonds, local currency corporate bonds, trying to say, right, we want that to become more mainstream, more recognized by investors. We're creating a product for that. Then a good investor is someone who will say, these guys have built something that balances risk, return, and impact, and something that we can invest in.
Thank you. So I think just there's a lot in that. Just to pick out, I think some of the common threads between a good lender and a good investor. I think there's there's mission alignment if it's really on the private side, but then you need a level of sophistication because we're talking about fairly complex structures, and lenders, investors need to know what they're doing. Maybe Alex, if I could just turn to you and ask you to tell us, okay, well, we'll talk about loans, we're talking about lending, we're talking about bonds in the private markets, but then when we get to perhaps more structured type of instruments, why would we do that? Like, well, what is the benefit of doing securitization in the first place?
Well, you can always try and get back lending, and doing a securitization can be more cost efficient. Without going into the nitty gritty, if you're a company trying to raise some money and you go to a bank, and as you mentioned, you may have to put up some collateral against it, or the bank will weigh up credit worthiness, whether it wants to lend to you. And typically, investors, lenders feel more comfortable in a structure where the ownership, where it's beneficial collateral is given to them rather than taking credit risk against the company. So when you set the securitization deals up, typically the structure will be that the company looking to raise finance will sell a portfolio of its assets to a newly formed special purpose vehicle. And that vehicle with its assets forms a security for the investors or lenders in the deal. And it's typically limited recourse to that. And when we talk about the assets in the deals that I've seen in this space, we're talking about receivables. So the company has customers, say, in a country which it sells solar home products, and it's selling in the rights under those customer contracts. So the customer's got to pay for the solar home product and for the ongoing use of it. So the money, the cash flow from that is sold into the deal. That's what backs the investment. And these types of deals can be very complex, or they can be simple. And my advice to entities going into this sort of world, to raise finance, particularly in impact investment, is keep it simple. Start small, keep it simple, and then as you get more experience, as your lenders move on that journey with you, and you have that mission alignment, you want to bring in new structures, new investors, then you can think about making it.
Great.
Maybe
Maybe
just for one point on that, because it's something that comes up a lot. Isn't securitization bad? Bad securitization. But if you look at South Africa, which is probably the more sophisticated capital market, and I only know this because the bond fund has been quite active, really in that asset class. It's listed under the JSE as asset-backed securities, I think, ABS. And there you have the sort of businesses you have issuing credit. There are companies financing public transport minibuses for individuals who can't get bank loans. You have affordable home loans and mortgages, including tenant purchase. You have a company called the Trust for Urban Housing Finance, which is probably the most impactful business of its kind I've seen in Africa. They renovate downtown properties into affordable apartments. And then fourthly, a business providing microloans for housing development. It's become a pretty accessible space beyond just sort of the normal, what we think of as the normal course of capital markets.
so in those cases, why would they choose the securitization route? What's the benefit for them?
Well, so I mean, you alluded to a few, but you have different types of differentiated types of investor within that space. So in the extreme, and a lot of these guys have gone the full hog, 6 note classes, junior layers. They're saying, right, well, there's an investor who likes the additional yield and will take a bit more risk for that. They're able to match investors willing to take a bit more risk for a bit more return, and then those who want just the pure liquid traded and credit enhanced senior layer. And so, and to the point you made, ultimately, in those true sale securitizations, the investor has some principal asset, conceptual asset ownership. Actually, in South Africa, the problem in the solar home system space, often quoted, is that you don't have backup services, someone to step in if the originator goes belly up. Well, in South Africa, you do in multiple different sectors. And so that's part of the market work.
And it sounds like, and the key thing with all these structures is being able to pull in investors who otherwise wouldn't be able to participate in the assets, right? Which I think is exactly what this entire event is all about.
And they've actually then pioneered things like social and sustainability frameworks. So a lot of these guys are now issuing, and in the anticipation of the rooftop solar market taking off, we're seeing interest in how that can access the capital market.
I was gonna do one more round of questions, but let's just jump straight to Q&A. You gave a hard ball in the main room. Let's see what we got.
My question is, as I said downstairs, I'm just trying to fathom these carbon sequestering technologies which have been obtained not out of nowhere. And I ask a lot of people, where do these resources come from? Whether it's Afghanistan, Libya, in my case, India, it was a forest, it was a cluster of forests. And when I look at the supply chain, I'm like, oh, saying about this from oil, you need fossil, you need to burn fossil fuels to make all the components of winter for a solar panel. I must follow the whole supply chain. I was like, well, my land is rich in lithium, and cobalt, and bauxite. This forest that's been here 2,000 years, religious significance, environmental, whole ecosystem, completely disheveled, strict mine. And now we've got floods for 20 years, long time. For renewables, this is happening in Africa, this is happening all over. My question is, downstairs they says, oh, these problems are there. I was like, yeah, but the problems have been facilitated by our own volition to actually push for renewables. And then those countries lose their land. And then they're in debt. I can't really still fathom how this is in any way, firstly, tenable and sustainable, because it's the indigenous people in every global south who are sitting on the richest reserves of the minerals that are needed for the Green New Deal. But they're not just barren land. It's like the Amazon forests. So I'm just like thinking, what's the downstairs? They were saying, oh, they need to engage, but how much of that? How much has industry really put indigenous people front and center? And if they were put front and center, who in the right mind would say, all right, you can take our forests? That's what I don't really understand, because there's huge issues. You've got your electric car, but you haven't got any infrastructure. You're not going to electrify the whole city. Where's all that resource going to come from? It's going to come from Africa and India. So my question is mission-driven, but mission-driven for who?
Got it. So I could take a stab at it, and I'd love to pass it on to any willing panelists. So I'll tell you from the chair that I sit in my day job, which is Citi, big, large global bank. We're in over 90 countries around the world. In the work that we do, our intentional focus is to focus on the last mile and to work with companies that are expanding access to basic services, creating jobs, building basic infrastructure. We don't do any of that stuff ourselves. In a place like Sub-Saharan Africa, we're present in 16 countries. In most of those countries, we have one corporate office. So we started off with microfinance, and the essence of that work has always been working with partners. So we never did microfinance ourselves. We don't have that footprint. So it's working with the local partners on the ground. And that now translates to all the other sectors, whether it's off-grid solar, whether it's agricultural inputs, housing, etc. And I think most global corporations are in a similar place, in the sense that they don't do it themselves. They work with partners. And a lot of times it's very complex value chains where they are many steps removed from the local communities, and they just may not have the visibility despite their best intentions.
This is nothing more than green colonialism. And the problems we now have to solve are the problems being created by looking for solutions, which is mine another piece of forest to get those resources and let those black and brown people worry about the planet.
So I'd love to hear some other voices as well. Any of my panelists want to?
Yeah, just quickly. I mean, there's no invalid concern there or attempt to invalidate concern. Concern is real, and also a lot of the development finance institutions we work with today, at some point in history, have played a part in activities that wouldn't be allowed today, right? So, particularly the development of the palm oil industry in Southeast Asia. But there's, I mean, I would encourage you to look at something called the IFC Performance Standards, which lays out quite an extensive framework for how these issues, how environmental and social risk, by risk, it's framed as risk for the investment, the project, but ultimately it's risk emanating from the environment, the local social and environmental features of the area affected by the project. That is quite a lot of work for financiers to deal with and implement. It's not perfect at all, but it's designed as a framework to prevent exactly what you're talking about, being financed certainly with public resources. I don't work for a DFI or an MDB. It's not my fight, but there are frameworks in place that try to deal with it. And bringing it back to the theme of the topic, that's why an institutional investor in London wants to co-invest with a development finance institution, because it comes with a halo to some extent, or an insurance underwriter in the Lloyd's market wants to wrap a tranche of a loan, engage in what it sees as responsible investing, because they're assuming and working on the assumption that the lead investor as an official institution has done the work to prevent that happening. Perfect, and I'm sure we can think of multiple counter.
Can I ask you about securitization? I'm really interested in securitization, but you were describing single company securitization. So how small can these securitization things be? I'm interested because I'm seeing a lot of securitization in developing countries, but not in the UK, for example. And yet I think there's a microfinance industry, a tiny one in the UK. Would securitization work in the UK as well? Because normally the objection is it's too small or it's too expensive, but you're describing quite small transactions, a single company loan that gets then put into an SPV and then tranched and securitized. So it seems like it's more possible, but I don't understand enough of the economics, but can you do really small securitizations? Because that sounds really interesting.
Well, yeah, well, the transactions that I've been involved in, they've been under 100 million. And
That's big where I come from, but okay, go ahead.
You're absolutely right to ask the question, because doing a securitization has an upfront cost, and you have to weigh up that cost against the finance you're raising. And so if you're looking at getting, two sets of lawyers in various different jurisdictions that might be involved, and your upfront costs are sort of looking at around 1 to 2 million, you've got to factor that in whether that's worth it if you want to do a transaction which is say 10 million, whether that's invested. In the example I mentioned, a couple of the deals I've seen is sort of raised about 50 million, and so they made a decision that it was viable, and within 4 months they got another lender in to lend another 10 to 15 million on top, and now they're into the second transaction. So you can start small, simple, attract the interest, build more, make it a bigger deal the next time round. That's feasible, but you're absolutely right to ask the question, is it worth it if your capital being raised is actually very small compared to the cost of setting up a deal?
I guess the one thing I would add, in emerging markets, it's a very nascent space. So there's an ongoing effort to understand the regulations that are in place. That takes legal resource as well. I'm not a UK securitization expert, but I would venture a guess that it's a fairly established space here, and the rules of the road are known, which probably makes it more efficient.
Yeah. And one thing I would add is, I think everyone in this space is doing an excellent job in recognizing the use of finance to invest in deals like this, to do good things in the world. And law firms are not dissimilar to you. And here at A&O, and I'm sure other firms too, we recognize that. And so, if you're thinking of doing something like this and fees are a concern, speak to your lawyers. If you're looking at us, speak to us. We invest too. We've done a portion of deals like this in the past on a pro bono basis because we think it's the right thing to do. As a firm, we want to have that recognition that we're there to help. And so, where we can, it's put to a committee here. And in the deals I've worked on, we've been able to, take a sizable chunk of our fees to do it for free because it's right.
I think you'll be a popular man later with the drinks.
How big are the deals that you've sort of progressed? Have they got bigger over time?
So I would say the largest ticket size on the debt side that we've done is about 15 million. Going back 10 years, where we were starting at, debt sizes of about 250,000. so significant scaling on that side. And we have had, a lot of investors that are, coming back to invest, a second time and scaling their investment. So yeah.
So the question here.
Yeah, just a couple of questions. I think one on the impact side and one sort of on sector side. Yeah. So I was with the UN Capital Development Fund where probably about 10, 15 years ago, we started investing in very small startups on solar home systems and off-grid energy system companies. And since then, we've had cases of people like M-Copa kind of growing significantly, all aided by sort of digital technologies that allow for footprints to be tracked and so on. I'm just wondering, on the debt side for the investors, how do you track the impact, and how important is the impact, or is it just simply that we assume that investing in a company like M-Copa will produce the impact? We're not too bothered about sort of tracking it. So that's just one question about how you do that. And the second is, I've been having kind of conversations with companies looking at improved cook stoves, which have a massive impact and so on. But they struggle tremendously in securing capital because the amounts of money are very little. So you wouldn't get out of bed, as you said, for less than 100 million, for example. And many of these companies require less than $500,000, about $500,000 dollars. So how do you kind of, what sort of role, what needs to be in place for you to feel that sectors like clean cooking and so on is attractive? So what needs to be in place by people like KfW or other funders and so on for you to say, yeah, okay, I'm ready to kind of come into that market?
So I'm mindful of time, so what we're going to do is the two other questions. We'll take them both now, and then I'll let the panelists see what they want to answer.
Just a really quick one. So when you lend to an entity, you can measure impact and you can measure ESG, and you have a lot more oversight or insight into a particular company. But from a securitization perspective, how are you seeing the market trends from an ESG impact measurement perspective? Because you can't see all the way through to the assets or the loans, or you don't have that data. So how are you looking at that?
I have one broad question and one specific question where Alan Aubrey can come in. You heard about the foreign currency convertible bond, FCCB, which India has used it largely to raise almost 20 billion pounds from the European market, by the UK or. So I don't know about how it is structured. It's some sort of bond issued by the emerging countries, corporates, to raise fund from this with an option to convert it in a manner in different area. So can you give some idea as to why this FCCB market is running now or has failed? Because these bonds ultimately listed in different markets, whether it's Singapore or and it are traded, and it has a different view. So can you give some idea about how it operates here? And number two, what is the statistics of bond market, corporate bond market in Europe? These two questions. And I have an opinion which you can consider. This embedding the ESG is going to kill this total finance industry. It's a nonsense. This is my opinion, personal opinion, has nothing to do.
Anybody want to take ESG impact, measuring it, tracking it, is it possible in securitizations? I feel like you may be best placed.
Different ESG transactions, track things in different ways. I guess a lot of that is done outside of the lawyer's ambit. What I would say is I'm seeing increased levels of undertakings in deals on that, and different investors have lists. Right? So, whereas before there would be some sort of common ground to the you need to achieve this. we're seeing in deals with multiple investors, each one has their specific policy and term of requirement, and they not only require the borrowing party to comply with that, but they're looking beyond that to every transaction party. Can you make sure you're doing this? Can you make sure that any use of the money that makes its way to you as payment of your fees is not used in the following? And so, from a lawyer's perspective, the way it's measured is a sort of a negative covenant manner, which is don't do this. And if you do, you're in contractual breach. So you can keep a parameter around how that financing is used.
Securitization opens up the door for something else. I mean, the key principle in securitization is asset qualification criteria. Assets have to have certain risk return features to qualify, but they also, in some instances, have to have certain impact features, right? And you can say, right, well, does that sit with the originator of the loan? How robust is their framework? And then I have to go and do diligence of the company. That wasn't the point of doing a securitization. Or you can say there's some recognized industry standard that's applied, so there's a bit more of a standardized approach to how impact is measured. But you say, I'm only investing in those assets.
James, I'm going to just ask you to do the clean cook stoves, which I think translates to smaller. How do you take smaller financing needs and?
Yeah, it's tough. I mean, clean cook stoves have been around in different guises in Africa. The model that I guess the lazy answer as a finance provider is who's going to scale the product, right? And so Bbox, a competitor of Copper, is now pioneering affordable LPG clean cooking, which avoids cutting down of trees for charcoal. LPG is not perfect, right? But it's order of magnitude cleaner and less detrimental to health than using charcoal. The reason they've been able to do that is they've got the platform on the Solar Home Systems. It's a pay-go model. The technology is largely the same. The distribution networks are largely the same. So they've figured out a way of scaling. There are purely commercial companies in East Africa. I'm sure you know this. Coming out of the likes of Proto, and then the big international commercial firms like Vitol will have subsidiaries doing something similar, but in a much more sort of, let's say, middle class target, mass market. If in terms of how we've tried to take smaller initiatives, where we've, I'm thinking of bond fund here, but where we've tried to take initiatives from an early stage and scale them. See, not everyone can issue a bond, not everyone can get a rating, not everyone's suitable for a pension fund to invest in. But what we've tried to say is that, well, we think the Zambian Home Loan, good example, doing affordable mortgages in Zambia. Their balance sheet was $3 million, I think, when we invested. And what we've tried to do there is see what products we can advance. We say, right, this company in 5 years should be funding itself in the capital market. What they need now is some sort of loan that provides them with liquidity and some flexibility to get there. As a provider of debt, and also with a sort of minimum check size in most cases, that's as much as we can do. I should say we also have technical assistance. So a lot of the likes of KfW provide technical assistance funding to cover some of the costs associated with what we're doing, and including sort of impact frameworks, measurements, etc.
The only thing I would just add on, particularly on the cook stove side, is it's a sector that's very friendly to carbon offsets, which that market is back. I think we're out of time. I'm sorry if we didn't get to all the questions, but I'm mindful that the other panel may be starting now. So thank you very much. I hope you found this useful, interesting, and if you want to continue the conversation after the next panel over, thanks.